delighted to be here this afternoon. My name's Sara Ager. I'm the CEO of GreenKite Associates. We're a London market-based insurance consultancy, so we help insurance companies and broking companies. And as an organisation, we're actively involved in the Insurtech community. And I'm delighted to be hosting this panel today with a number of eminent speakers. The topic for today is how we're going to use technology, AI, or indeed different methods of distribution to access those untapped communities and indeed offer insurance products to people so they know what they're buying and they get what they want to cover their risks. So without further ado, I'm going to introduce our speakers, if I may. So to the left of me is Ian. Thank you very much, Ian. Ian has worked 40 years, is that fair to say?
That's fair to say.
Fair to say, 4 decades. So a very experienced person working in microinsurance and has estimatedly helped 5 million customers to access finance within South Africa. So well done for doing that, firstly, sir, and for joining us today.
Thank you very much. Great to be here.
James, to the left of Ian, I think. So James York is a serial insurance expert. He pushes the boundaries of insurance within the London market. He was one of the co-founders of Insurtech UK, who are a membership organisation lobbying the government and regulators to develop the insurance market and distribution practices within the UK. And he now is a director of a number of companies and also works with V49, which are an innovation hub, and he's a consultant there with those. So thank you, James. Amjad, right at the end, but not by far no least. He is an IT technology PhD based here in Cambridge and actually has been fundamental in developing the Crosure product. So is familiar with customer journeys, different territorial requirements, and actually the needs of technology to represent the individuals. He's committed to closing that protection gap, so thank you. We have now been joined by Claire. So Claire Carpenter is a regulatory and compliance expert within the UK. She has 20 years plus experience, an interest in anything tech. She and I have worked on a number of kind of new product ideas in parametric and embedded insurance. She now currently works at Vale Insurance, which is a global MGA business who are involved in after the event insurance, so providing access to justice and the legal framework for lots of individuals. And by no means least is Dylan. Dylan sits to my right. Dylan is also a seasoned insurance professional, although he began his career in private equity. He now is involved in a number of insurance innovative products and companies, but also is in a deep tech fund. Is that right, Dylan? Yep. So Dylan comes having built an Insurtech from scratch with a wider societal impact, and having sold that business comes with lots of experience this panel. So I hope we'll be able to kind of enlighten you a little bit about what our views are on the market and society. And on that, you've probably heard enough from me, so I'm actually going to hand over to the panel. We'll be looking at the legal and regulatory requirements. We'll be looking at the products and distribution requirements, and actually what we've currently got and how we can access that technology and indeed develop that technology to serve communities wider. So if we start, if we can, to set the background around the legal and regulatory framework around which insurance is distributed, primarily in the UK, but actually global. Regulation is obviously can be seen as an enabler, but also I think in respects of AI and digitalization can also be a barrier to innovation and a barrier to access. So Claire, can I firstly ask you, how do you think regulators can strike the balance between consumer protection and innovation? And when technology is used to extend cover, how can we ensure that the correct protections are there for customers and the correct amount of knowledge is available for them?
I think it's a tricky area. Certainly from my experience, the FCA in the UK have not been particularly proactive when it comes to the implementation of AI and how that's moving forward. And I think that strikes some challenges because then it's left to the market. And I think, in particular in the Insurtech space, and not just the UK, but in the EU, there's a bit of a blind spot about what MGAs and Insurtechs are. And that leaves a little bit of a gap in terms of knowledge from the regulator. And I think ultimately, if you leave it up to the market to develop these things, ultimately the regulator becomes, in a position of doing a post-mortem rather than helping, develop the market.
And James, at the forefront of lobbying the government and the regulator, do you think that there's something more that the regulator could be doing to kind of use AI in its protection of customers just as much as its distribution of products?
Yes, I mean, I have three thoughts on the matter. One is to do with open data. DUA, I think it's the Data Use and Access Act, the Smart Data Act, should now allow open banking to migrate across to insurance. Now, if the FCA were to enable that, then obviously AI requires data to learn. So that would give Insurtechs much, much more access to your data to enable you to have the kind of experiences you're getting from Fintech. So that's the first pillar. And there's a sandbox experience already in place with the FCA. The second piece for me is very much about how the FCA uses AI itself. It currently fields a lot of calls from both individuals and people in the industry. At the 49, without blowing our trumpet on products, we have a QA product which leverages multiple LLMs. I think the FCA could do a lot more in terms of reducing its cost base and burden to ensure that it's delivering a lean service, because that cost is always passed on to consumers. And the third piece is about and this is very much, I hope Adam from Google isn't necessarily here, but Dylan and I just checked before we came on stage. AI is making regulated recommendations as we speak. And we've already had search engines doing that. I'm sure Vale have got some class action interest in that too. But in terms of competition, we've seen what's happened in America with regards to Google and search data. I think it's imperative the FCA really is robust about how it enforces competition and ensures that the standards that regulated agents and insurance companies are held to are migrated across to LLMs, which are making recommendations, often in free mode, to vulnerable customers.
Useful and interesting. And I can see you nodding violently there, Ian. Do you have something to add in there from your experience?
Yeah, so I've operated in 14 African countries bringing banking and insurance products there. And I've always found regulation needs to be fit for purpose. Sure. So you don't want to overburden that, especially in the micro insurance or micro banking space. And I do find, enabling people to be juristic reps of insurance companies does enable that and allow you to get out there. And I do think there needs to be the guardrails, by the regulators, whatever you call them. We call it a financial sector conduct authority, slightly different to yours. But we find that where they do have the light touch on microinsurance, it does enable innovation and rollout to underserved communities, especially when you look at, developing nations where over half the population are in the rural area. They're not urbanized. So you can't get the consumer to come to the insurer. The insurer has to go to the customer. And so you've got to enable that the other way around. And I think there's a lot of thought on how you do that in a mindful way that does enable that going forward, which is quite interesting, especially when you across multi-territories as well, where each regulator and the sophistication of the market is in different stages of evolution.
And I think it's also, I think rural and kind of urban is a good differentiation, but there is also some barriers to breach just in that way with age and diversity, ethnicity, cultural ties, and actually how people access that information, and maybe we can cover up on that later. I know, Dylan, you feel quite passionately about data and AI and how we use it in the right ways, but do you think, how do you think the regulator, or do you think there is any algorithmic, that's a mouthful, isn't it, risk of some of the AI tools that are being used currently in the market?
So insurance, the lifeblood of insurance is the data. Unfortunately, when you start understanding the industry, you realize that, this is not new. There was a whole big data spree about 10 years ago. And that was the kind of the AI buzzword at the time. And then everyone realized, actually we've got all this data, which dates for ages, but it's not in a format that actually can be used. Or it's on paper format, and then you have to digitalize it, and then you have to then turn it into a format that can be compared. And so effectively, I think there's a big misnomer with regards to the depth of data sets that the insurance industry really has. Which then means that when you start underwriting, you can start underwriting with a whole bunch of other kind of factors or data sets that are not necessarily embedded in from the insurers. Now, before I go on to that second point, the first point is that every data set is basically, of any given insurer, is based on their previous underwriting results. So effectively, if they are excluding a population, they're never going to have information on that population. So they can only kind of optimize further using AI on the populations that they've been targeting in the first place. So does that lead to great innovation and great kind of coverage of greater people? Not really. So the only way you can really kind of expand, and also, by the way, they all have the same focus, so they all came to the same conclusion. There's a specific kind of population that's really profitable, so let's all go after it. And that's pretty much true across all insurance classes. But when you're looking at consumer insurance, it's very much clear that there is a segment that's particularly targeted. When I built Social, we were actually focused on providing a broader coverage by actually not having the same algorithms and the same approach than the traditional insurers had. And we built our own data sets to be able to understand how to better underwrite the segments of the population are typically ignored or excluded from most insurance, by most insurance providers. And we didn't need AI for that. So I think it is mindset. And so then kind of goes on to, if we are going to be using kind of loads of data and expand the customer bases, we need to think about a lot more broadly about what could be relevant data sets for specific risks. And then how do you access them? And then basically it becomes an arms race of data, which has always been the case, remains the case, and will continue to be the case. So the question is, who's got the data? And if it's not your proprietary data, then anybody else can buy it too. So there is then I think the real dynamic here is actually who's going to create data sets of proprietary data that gives them a competitive advantage in the marketplace. And that does allow them to expand the addressable market rather than just focus on the segments on which they're presently doing.
So that sounds quite depressing, actually, because it means the market's going to continue as it is, and the unrepresented may never get that representation. Do you have a view on how you might tap the untapped, so to speak?
Well, we did it at Social. So we were, I think the comparison site told us they were increasing their addressable market by 20% just by the fact that the way we underwrote and used, instead of actually discriminating people on postcode, we use technology to verify the state of what's being insured at point of inception, which means that suddenly it's not because you're in a high-risk postcode that you can't be insured at a good price. It's just because we know that you're not lying to us. Whilst what happens with traditional insurers, there's fraud in a specific postcode. From then on, that postcode is barred, and we'll never underwrite that risk ever again in that postcode. And so you can imagine that's not very helpful for all the other neighbors who didn't do anything wrong. And so that's kind of, I suppose, the mindset we had at the time. And I think the point I'm making about everyone wants to have a competitive edge, and I think every insurer is understanding they need to build their own data sets. And I think there is, maybe not in consumer so much, but I think it's certainly happened, especially with the IoT and commercial lines. And there's been, and parametric is another one element of it, which is basically building their own data sets to better understand the risk they are underwriting. Now, actually, and then kind of, I think the next stage becomes a kind of philosophical perspective, which is, if I'm starting to underwrite because I know exactly your risk perfectly, then this is no longer a mutualization of risk. You're basically paying a payment plan by the way, a payment plan where 40% of your premium goes towards the value chain. So then there's a whole bunch of opportunities of creating new insurers of different types who might actually be stepping in. But that's a whole different conversation.
And maybe, James, you might want to pick up for our audience, because for those of us working in insurance, parametrics is pretty day-to-day business these days. But actually, for some of the audience, that might not be clear what a parametric type of insurance product is and what the triggers are. Would you mind briefly explaining what a parametric coverage offers you, and actually maybe use some of your experiences from Insurtech UK to kind of example how that's working on a day-to-day basis?
So, I mean, the simplest example would be there was a flood startup that created a piece of hardware that you bolted to the side of a building. And when it told the underwriters that water had reached a certain level, an insurance payment was made. Now, that sounds very, very simple, but it was very much beyond the wit of the market for a long time, even though the technology was there. So anything where there's a data event that has triggered a poor reaction for a consumer, rapid indemnity can take place. And insurers should like that, because it allows them to, not have to deal with the hassle of claims. The hidden cost of insurance is often handling the claim. And the quicker you can get it done, the better, if you were going to pay it anyway. Obviously, some insurers' models, dare we say, likely handle on the cash flow management of delay, but that's for another conversation. So parametric is basically action, reaction, and the indemnity is the reaction.
And in the territories that you've been working in, Ian, I suspect or anticipate that parametric is a good way of accessing communities. Have you had experience of parametrics or not?
No, not, but I think there's a slightly different angle to this. So as opposed to underwritten policies, non-underwritten microinsurance policies is a way to get in and get the data, because I know nothing about you because you're not in the system.
Yep.
So co-partnering with I was actually in a retailer for a long period of time, and we partnered with an insurer where a third of all customers that came to us were thin file clients at the bureau. They had no bureau record. And because we had a nice merchandise margin, we could take more risk than a bank could take. So we'd bring in the person into credit first and then into microinsurance. Now I know a bit more about you, how you pay your credit, how you pay your insurance policy. And some of those ones, and we did it for many years, 25 years of partnering on this one. And so it's probably a lot more than 5 million people we brought into.
Sorry, I didn't mean to understand.
No, it's fine. No, it's fine. It was in my profile. So there you start then bringing the person in, and then you can move from non-underwritten policies to underwritten policies, because I know a lot more about you, and I've now got the big data. And I think it's the conversion of retail banking and insurance together is going to be the new frontier for a lot of people. And if you look at Africa, 1.5 million people, half of them have a phone, and currently 36% are smartphones. And by 2029, 67% will be smartphones, which changes that. And if you think about Vodacom here, they own Vodafone here, own Vodacom. They're now selling a smartphone for £25.
Okay.
So they can do away with 2G and 3G and going to smartphones. And I think that's how you take insurance to the consumer, as opposed to trying to get them to come the other way.
So my question was going to be to you, Ian, actually, what roles do partnerships with kind of governments and NGOs and mobile telecoms work? And I think you've answered that one already as far as mobile providers. Outside of mobile providers, do you see any other kind of means of accessing these people who, for the purposes of insurance, don't exist? Not sounding crude, but they don't exist.
No, they actually lost, they lost mass. That's out there. It's a big population. So I do think it's, you got to walk a mile in the shoes of the consumer. So I think there's a healthcare play. So there's healthcare, and how do we bring healthcare out there? And so there, if you go through Africa, there'll be clinics. You'll go there, you arrive in the morning, you take a ticket, you wait to be seen, but you don't get seen today, you've got to come back tomorrow. So I think there's a whole play on healthcare. So partnering with healthcare across Africa or other developing nations will be a big play for distribution. I think the online digital play is a big one. So I think with the convergence of banking, retail, and that together, there's a big play there to embed products. So if I'm buying a Samsung TV, how do I get the insurance that goes with that? So the cost of acquisition also drops down. And if you can do that, you can then provide profitable insurance to more people, because your cost of acquisition is dramatically lower. Your cost of maintenance is lower if you embed it into the mobile space, which I'm particularly excited about. I think the mobile guys have good brands, great distribution channels, a billing platform, a collections platform. So I think they've got a convergence of a whole lot of things.
And distribution.
Yeah, distribution, great distribution.
And microinsurance typically has focused on the life insurance, hasn't it?
Funeral plans.
Yeah.
And very interesting there. So, we saved people from going into a debt trap because in the Southern African marketplace, you want to give a person a good send-off and a year later, remembered service. They will go into debt with a micro lender and have to pay off their debt for 5 years for an unforeseen event.
Wow.
Now, for a small amount of 50 or 60 rand, so let's call it, I don't know, £4, you could do away with getting into a debt trap by just taking out a micro insurance, and it works exceptionally well.
Sure. I think that leads really nicely. It's a really nice segue onto the next area I'd like us to think about, and definitely it's something that I ponder on a lot, because I think at the moment, particularly in the Lloyd's and London market, we have products and we expect our customers to buy those products. So we don't necessarily design those products for our potential customers, or we design them for the customers that exist, not the customers that could be there. And there's this whole area around product redesign. And I'm going to go to you, Amjad, because I know you have some practical experience about designing a product to kind of cater for the needs of one of these said untapped communities. And as I say, I don't like that term, but it's difficult to know how else to address the people that don't have access to insurance.
Yeah, indeed. I think to build on the previous points that have been mentioned, I think it's, when we're thinking about, serving underserved communities, I think it's important to take a step back and look at the fundamental risk involved and to engage with the people and the stakeholders who really care about that risk. So I think a use case which is clear, very close to my heart is the mini health insurance product we are now piloting in Jordan. And the reason why it's close to my heart is because it's part of the story, part of how I was confident about why this product is important is because my sister is a doctor and she works in the emergency department, and she's seen how in her own eyes, how a lot of people would arrive at the emergency department, and they would arrive, they need a quick intervention. So for example, if you have a stroke, you need few hundreds or sometimes few thousands of pounds for a quick intervention, and not all people can afford that type of.
You call it mini health.
Yeah.
What do you mean by mini health?
Yeah, so mini health is a little bit more of, so it's more than micro health. So it's the actual cover is capped around in a total year around £15,000, but on a single cover like £4,000. So which is essentially covers most of the emergencies, most of the critical hospitalization that is required after.
So it's aimed at a specific event that the customer
exactly.
may face.
So for example, a heart attack or a stroke or that kind of critical illnesses, and in essence, it can be life-changing because again, many people can't afford that amount in a timely manner, and even if they can borrow that money, they fall into the cycle of poverty just because of the high cost of private sector in that part of the world. So I think a lot of now we are aware of a lot of development agencies like the UNDP creating consortiums involving governments and involving also people in the London market as well, to actually create an ecosystem where you can actually build trust through the national consortium, but also have a robust, backing from major insurance, and also partnering with potential distribution channels on the ground. So I guess that's potentially how I would see the
And that's
formula.
a live scheme as we speak. It's a live scheme.
Yeah. And talking, I think, on data, I think one aspect which enabled us to actually onboard insurance companies in this product is that we had a robust understanding of the risk, because we highlighted the high frequency, the most important critical illness cases. These cases are well known and well understood in the clinical studies at the population level. So the risk is well understood in terms of the frequency and the severity, even at the macro level, even if you don't have individual data. And the tail loss and the tail sort of the variance in the loss is also capped. So that also enabled many insurance partners to be to take that risk. Even we had actually very little information, but we had really robust knowledge about the actual risk involved in the underlying product.
Thank you, that's interesting. And the panel has mentioned the word embedded, I don't know if the audience know what embedded insurance is, but maybe I can refer to you now, Dylan, so you can explain what an embedded insurance product is, and in particular, in light of social and your experiences with social, how you embedded that product into the sales journey for the customer to make it easy for them.
So embedded is the emperor's new clothes. It's basically insurance sold at point of sale. It's existed for a very long time, but if you recoin a new term, it becomes all the latest trend again. I think the big difference is how you can provide a customer journey that is, going back to your point, which is actually very relevant when you actually are providing the insurance in a very in a right context. So I'll have an example with one of our partners, which was a Fintech serving the less wealthy population in the UK, and what we could see is they basically had a open banking with their customers, so they were able to see how much, and you could actually, from the transactions, you can figure out what kind of insurer they're using,